Get ready for an eye-opening episode of Making Money. Jim Rickards is not your average market analyst. He sees the world through a different lens, questioning the actions of governments and the Federal Reserve. With an extensive background in strategic intelligence and as the director of the Jim Rickards Project, Jim brings a fresh perspective that will challenge conventional wisdom. Join us as we dive into the heart of the matter, the banking crisis. We'll unravel recent events and discuss where we currently stand. Are we facing a true banking crisis, or is there more to the story? Jim Rickards has never been shy about expressing his skepticism, whether it's towards the Fed or his notorious stance as a gold bug. Prepare for a thought-provoking discussion that will leave you questioning the status quo. This deep dive into finance will reshape your understanding and offer new insights. Don't miss out on this opportunity to gain a fresh perspective on the financial world. Tune in now and get ready for an enlightening experience. What's happening in the market lately? We've witnessed another major bank failure, and it's safe to say we're knee-deep in a banking crisis. As for where we stand and what lies ahead, the situation remains uncertain.
Well, third major bank failure is one way to put it. It's actually the fifth or sixth, depending on where you start. Most people go Silicon Valley Bank, Signature Bank, First Republic, and that's right, three big ones in a row. But before Silicon Valley Bank, there was the failure of something called Silvergate Bank. And Silvergate was interesting because it was an FDIC-insured member bank, a regular bank in that respect, but it was a portal to the crypto world. It was a bank that exchanged crypto for dollars and held crypto accounts, et cetera. And then that failed on March 9th. Silicon Valley failed on March 10th. Signature Bank got whacked on March 12th. So a lot happening very quickly. And then a week later, on March 19th, we saw Credit Suisse in a shotgun wedding with UBS, orchestrated by the Swiss National Bank. That's one of the biggest banks in the world.
Jim Rickards brings the banking crisis to the forefront as banks crumble like a house of cards. From Silicon Valley Bank to Credit Suisse, the dominoes keep falling. It's a high-stakes game of poker with risky moves and unexpected plot twists. The convergence of traditional banking and cryptocurrencies adds fuel to the fire, creating a roller coaster ride of uncertainty. The fragility within the banking sector becomes evident, and the consequences are far from over. Wall Street may try to paint a rosy picture, but a storm is brewing beneath the surface. Brace yourself for more twists and turns in this thrilling banking drama. The ride isn't over yet. Large banks versus smaller banks. Indeed, First Republic received significant support from the FDIC, which added $500 billion to their bottom line and helped retrieve some of their deposits. It does appear that they secured a favorable deal. As for the larger banks like JP Morgan and Bank of America, they could potentially benefit from this situation. However, the question remains, when will the sequential targeting of banks come to an end?
Well, it either ends when, it can end two ways. One is something like 2008, but worse, just a generalized global financial crisis where everybody's getting the money out of every bank, either buying treasury bills. Treasury bills at a brokerage firm are pretty safe.
That's something we can't predict at this point. Jim Rickards, a strong advocate of diversification, humorously emphasizes the importance of not putting all your assets in one basket, stating, "You don't put all your assets into anyone who asks the question." Moving on to gold, he acknowledges its volatility and quips, "Why isn't it at $5,000 or $10,000 an ounce? It'll get there, and when it does, hold on tight because it'll skyrocket faster than a shooting star." Jim pointed out that as gold's value rises, each incremental gain becomes an easier hurdle to clear, saying, "It's like making the same $1,000 an ounce, but with each step feeling lighter than a feather." He paints a gripping picture of the potential consequences we face. It's not just a repeat of 2008 that looms, but an even more formidable threat, a generalized global financial crisis. In this alarming scenario, we witness a frenzied stampede as individuals desperately withdraw their funds from every bank, seeking refuge by investing in the safety of treasury bills. In the finance world, there's hope in segregated funds. Customer funds are kept separate, like fortresses protecting assets. Audited accounts ensure security during tough times. Gold and silver endure as resilient safeguards, immune to hacking or freezing. Yet, many overlook their value in crisis. Seeking secure wealth repositories, thoughts of insurance, or nationalizing banks arise. But what risks do they bring? What potential consequences lie ahead? With each crisis, bailouts grow, stretching the Federal Reserve's capabilities. Are we nearing a breaking point? Could confidence in the dollar itself be at risk? In the face of such uncertainty, we are left to ponder the immense challenges that lie ahead and the critical decisions that will shape our financial landscape. Reserve currency versus payment currency. Jim Rickards compares the dollar and gold to a seesaw. When one rises, the other falls. The price of gold depends on the strength of the dollar. During uncertain times, both the dollar and gold can rise as investors seek safety. This creates a demand for dollars and increases the value of gold as a sanctuary. However, amidst discussions about the dollar's future, Jim identifies a common source of confusion. Many fail to distinguish between the role of the dollar as a payment currency and its role as a reserve currency. As a payment currency, the dollar's acceptability for transactions is determined by its confidence and widespread usage. In contrast, a reserve currency refers to the holdings of securities denominated in a particular currency. In the case of the US dollar, its status as a reserve currency is bolstered by the depth and liquidity of its securities market, the extensive infrastructure surrounding it, and the rule of law that underpins trust in the system. While the potential for other currencies to challenge the dollar as a payment currency is feasible, displacing it as the leading reserve currency is considerably more challenging. The dominance of the dollar in the reserve currency realm stems from its well-established securities market, unparalleled infrastructure, and global trust. Other nations, such as China and Russia, lack comparable markets and face trust issues, making it difficult to compete with the dollar's position. In summary, Jim Rickards highlights the intricate relationship between the dollar and gold, the factors influencing their prices, and the distinct roles they play in the financial landscape. The dollar's position as a reserve currency remains robust due to the underlying securities market and the trust it commands, making it challenging for other currencies to dethrone it. Let's talk about Bitcoin. I have studied Bitcoin extensively, but do not recommend it. While some people have made significant profits, data shows that more individuals have lost money. Bitcoin's limited utility can be compared to chips in a casino, and its value is subjective and speculative. In the long run, I believe Bitcoin will be worth very little. As for the island question, I would feel comfortable holding onto a diversified portfolio of stocks and bonds as a long-term investment.
Big believer in diversification. You don't put all of your assets into any one asset class. I don't care what it is, but I'd have a significant slice of gold. Yeah, look, it's volatile. It's been up and down, and people get frustrated. Why isn't it at $5,000, $10,000 an ounce? I mean, it'll get there, but it'll get there very quickly.
Is your investment strategy diversified enough? According to Jim Rickards, it's crucial to spread your assets across different options, like distributing eggs in multiple baskets. Rickards specifically recommends including a significant portion of gold in your portfolio, despite its volatile nature. As the value of gold rises, each additional dollar contributes a smaller percentage increase. For instance, going from $2,000 to $3,000 per ounce represents a 50% increase, while the leap from $9,000 to $10,000 per ounce is only 11%. However, the overall profit remains constant. This unique characteristic makes gold capable of reaching higher price levels rapidly. With high demand and shortages for physical gold, now might be the perfect time to consider its acquisition. Unlike gold ETFs, physical gold represents true ownership. So ask yourself, are you prepared for potential gains and the stability that gold can offer? Diversify wisely and let gold shine in your investment strategy. What do you think about this topic? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe to this channel. I'll see you in the next video.